So I think we've got a much lower US stock market before it's over. Bear markets always have rallies. The first rally in a bear market is typically the strongest. I think we've seen that rally, and the next leg is down.
1 ounce silver 2022 Noah's Ark coins at $4.25 over spot. Quarter ounce silver 2022 Noah's Ark coins $3.25 each over melt. Call 1-888-81-LIBERTY. 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And with us today again is a very special guest, Adrian Day of Adrian Day Asset Management. Adrian, thank you so much for joining us today.
Well, thank you for asking me again. Good to be here.
Well, it was fantastic to see you at the Rules Symposium, the Natural Resource Conference down in Florida, and it was a very interesting opportunity there because it seemed like we were at the bottom of the resource sector, the bottom for gold and silver, but all these mining companies were there, all these royalty companies were there, and it's like, wow, this might be the time to buy. And what you've done actually with your portfolio is you actually right now have the highest possible allocation to gold and silver. Can you expand on that?
Yeah, we're actually full on gold and silver. We have dedicated gold accounts where we are basically fully invested. And then we have global accounts where I basically got a full allocation on gold and silver, even though we're very underweight global markets and even other resources. But gold and silver, we're fully invested. The truth is I was invested too early, and this is what often happens. When you're a value investor, you see value and you buy it, but sometimes you just have to be patient. Certainly with gold, and even more so with the gold stocks, they have been extremely weak lately, much weaker than I thought they would be, frankly. Now, if I may just mention on gold, we need to put that in perspective. When everything else has fallen dramatically this year, gold is down about 5% as we're speaking, and that's after today's drop, whereas the dollar is up nearly 10%. I'm talking about for the year. So gold is holding up really quite well in the face of a stronger dollar. Now, US dollar-based investors may say, I don't care about that, but I think it's really important to understand that against pretty much every other currency in the world, gold is up this year, and in terms of some currencies, it's at all-time highs. It's really only in US dollar terms that gold is down because of the strength in the dollar. So I think that's a huge positive for gold, because it does mean when the dollar turns, and I don't think we're too far from that, when the dollar turns, gold should recover in dollar terms quite strongly.
It definitely does seem like that. Right now we're at multi-decade highs for the U.S. dollar, and that is putting a lot of pressure on both of the metals. But you see that reversing sometime soon?
Well, we know why the dollar has been strong. It's the cleaner shirt in a dirty laundry hamper syndrome. Every other currency around the world, however bad the U.S. dollar is, and the U.S. economy, every other currency and economy is probably worse, or not everyone, but the major ones: Britain, the US, Japan, China. And so the dollar's been strong because of that. The dollar's also been strong more recently, this year in particular, of course, because the Fed has been raising interest rates. I mean, frankly, they left it far too late and they haven't done enough. Maybe we'll get into that. But the Fed has been raising interest rates much more than Britain, Canada not so much, but Britain, ECB, European Central Bank, and of course, particularly Japan. So you look at Britain, for example, last month, the headlines in the paper were screaming, Bank of England raises rates to 1.25%. and they were talking about the huge hike that the Bank of England had just done. And that very same week, the Bank of England predicted that inflation would end the year at 11.25%. So you've got the bank thinking inflation is going to be 11.25 and rates are at 1.25. So compared with other countries around the world, other central banks around the world, other major central banks, the Fed is actually, raising rates. And that just increases the rate differential between the US dollar and other currencies. If you're a Swiss manager sitting in Zurich, you've got $100 million or $10 million or whatever, but you just want to park somewhere temporarily, well, you can actually earn 0.25%, 0.5% on your US dollars, whereas in ECB, they're charging you to hold your money in euro. So it's an easy decision for global managers. If you've got cash, you just put it in the dollar. And that's where the strength in the dollar is coming from. It's not coming from central banks buying US treasuries. Russia, as we know, is completely out. Japan and China have stopped buying for quite some time now. And both of those countries, in fact, have been net sellers in recent months. So it's coming from people just looking for, where do I park my money?
We are seeing a shift, though. For example, in the inflation rate, the rate of inflation went down for July. And the mainstream is talking about it, and the president is also talking about how prices didn't rise in July, so that might technically be true, but it doesn't mean inflation is not a problem anymore. But that mainstream narrative seems to be that maybe we're getting this under control. So do you see that impacting the dollar and possibly what the Fed might be doing next?
Yeah, lots of questions there. First of all, I certainly don't think inflation, I don't think inflation's under control by any means. And it's, first of all, when we talk about inflation, what we're really talking about is the increase in consumer prices. That's not inflation. And in fact, if you're too young, but if you look at a dictionary that's 20 years old, the definition of inflation was not rising prices. The definition of inflation was excess money and credit creation. That's inflation. Rising prices are a symptom of inflation. So we have inflation in the US. The Federal Reserve's balance sheet has more than doubled in the last 2 years. That's a rate far, far greater than the growth in the economy. So it's excess money creation by definition. So we have inflation. And it evidences itself in high consumer prices. Now, individual prices can go up and down for various reasons. And obviously last month, as everybody knows, we had the oil price come down and the price of gasoline came down. And that meant that the consumer price index in aggregate came down. But we still have inflation. So next month, we could find that the price of potash is up and the price of used automobiles is up or whatever. We still have inflation. But we should expect the CPI number to go up and down on a monthly basis. Now, I wouldn't be surprised, especially if the war in Ukraine ends, so that'll relieve pressure on, two of the things I've mentioned, oil and gas, as well as potash, which is important for food. That will relieve pressure there. So I wouldn't be surprised if in a few months the CPI settles at the 7 to 8 or let's say 6 to 7% range. I'm sorry. But 6 to 7% is still very high inflation, especially as it builds on itself. What we had, this last month, 8.5%, was 8.5% on top of 5% for June last year, right? So prices are not coming down. They're just going to grow at a slower level. So the Fed is raising rates. As I mentioned, they're raising rates faster than other countries around the world, but they are still way behind the eight ball, to use an American expression, way behind the eight ball. Because you look at where inflation is, in order to, and Volcker said this very clearly, and did this very, very forcefully, in order to bring inflation down through interest rates, you have to raise interest rates above the rate of inflation. We are so far from that at the moment, so far from that. So that alone is not going to control inflation. So we shouldn't be fooled if inflation, CPI numbers come down, to 6 and then to 5. That's not the end of the problem.
It definitely doesn't seem like it's the end of the problem because, as you mentioned, that 5 or 6% inflation is still incredibly high historically. Now, what we're seeing right now is it seems like we're in a period where we're seeing a slowing economy and also inflation, which is probably one of the worst case scenarios where you have this stagflationary environment. And the stock market has been reacting to this since the beginning of the year. We've seen quite a downturn. However, last time we had you on, you said that the stock market was poised for a rally amid this bear market, and that's exactly what we saw. So I think that was a fantastic call there. Where do you see the stock market going next?
Well, thank you for mentioning that. And, the truth is, if you make enough calls, you'll get some of them right. But yeah, I mean, the stock market was clearly poised for a rally there. It was oversold. And, nothing goes up or down in a straight line. And I was talking with some friends last night about that. I mean, we all as humans, we tend to extrapolate from recent trends. But things just don't go up in a straight line. I think this rally is over, frankly. My basic case is that we're now in a bear market for stocks. We haven't had a bear market, really, since the mid-60s to 1980s. 1966 to 1980 was a bear market for stocks. What we saw in 1987 or in 2000 or in 2008 were short, sharp declines. But even 2008, the market was back to where it was within a year or so, and in 1987, in a much shorter period of time, a few months. So those aren't bear markets. Bear markets are longer and protracted in a real bear market. So I think we've entered a bear market. Stocks remain grossly overvalued. You look at the S&P today is trading at over 19 times earnings multiples. Now, 19 is only low in comparison with where it was in January and where it was in the middle of the dot-com boom. But 19 times earnings in a weakening economy is not low at all. What's crazy is that the analyst forecasts, the consensus forecasts for earnings are actually for them to go up over 10% in the next 12 months. So if the analysts are wrong on that and earnings stay flat, don't go down, just stay flat. And that's a pretty conservative assumption if we go into a recession or if we are in a recession. And at the same time, the earnings multiple goes from the historically very high 19 to an historically high 17. We've got another 25% on the downside. And those are very conservative assumptions. So I think we've got a much lower US stock market before it's over. And the rally, I would suspect that the rally is over. Bear markets typically, bear markets always have rallies. The first rally in a bear market is typically the strongest. Typically 12 to 15% is a first bear market rally. We've had, from bottom to top, we had about 15%. We're still up 12% from below. So I think we've seen that rally, and the next leg is down.
Well, that's very sobering forecast there, probably for all the viewers there. But one of the things that definitely happened when we did see the first leg down from the beginning of the year for the first 6 months or so was we saw everything sell off, right? Even the precious metal sector, the mining stocks, as we mentioned, just a few weeks ago, it seemed like, gold and silver resource stocks were incredibly depressed. Do you see the same thing happening this time where during this next leg down, it could be, again, a sell everything moment?
Well, no. Typically what you see as you get into a bear market is you start to see rotation. And we saw a little bit of that. As you say, everything was down. But if you look, you saw that the value stocks held their own more than the growth stocks. The defensive stocks like consumer goods like Nestle, Unilever, they held up better than the tech stocks. And I think you're going to see, as we get into the bear market, you start to see more rotation. The gold and silver stocks, to my chagrin, as I'm sure everybody listening to this who owns them knows, they did not participate in this rally, or to a very, very meager and short-lived extent did they participate in the rally. So the major gold and silver stocks are back to their annual lows, and in some cases lower than their annual lows. So I think what we need for the gold and silver stocks, we need gold to move up in US dollar terms. When you look at the gold and silver stocks, number one, they're making good money. We forget that. The margins are still are very strong. They're lower than they were in the first quarter, but the second quarter margins were still some of the best for the last 20 years. We forget that because we focus on the fact that every company says, oh, our costs are going up. Well, yes, their costs are going up, but if their all-in sustaining costs are $1,100 and the price of silver is $1,750, that's a wonderful margin for anyone in any business. Even tech companies would like that kind of margin. So number one, they're making money. And number two, the stocks are stupidly cheap. Again, you look at a stock like Barrick, it is second largest gold mining company in the world. It's got net cash, it's net cash positive, its dividend is 4.7%, it's earning stacks of money. There's no major warts on the company other than the fact that they have a lot of mines in politically unstable jurisdictions. But, their political risk is diversified, if you like, from the Congo to Pakistan and Saudi Arabia. So they have a lot of risk, but it's a diversified risk. That's trading at the lowest price to free cash flow multiple ever. Now, that just doesn't make sense when they're minting money. And the same is true for many of the large cap stocks. So, but I think what you need, so the setup, what I'm trying to get at is the setup for this gold sector is wonderful. Most investors are underinvested. People who are into gold are overinvested, and people like me, we're fully invested. So most people I know have too much in the gold and silver sector. But for the investment community at large, people are incredibly underinvested. Mutual funds are underinvested, hedge funds, institutions, hardly anybody owns any gold or gold stocks anymore other than dedicated investors. So the setup is incredible. What will make it turn, I think, is gold going up to 1850, 1900, 1950 and holding those levels. And it's difficult to say when that's going to come, but I think certainly one thing to look for is when the market realizes that Powell and the Fed cannot control inflation without causing a serious recession. And the slightest hint we get that the Fed is going to pause for a significant period of time. They don't have to pivot immediately, go from QT to QE, but they're going to stop tightening. That'll be the turning point for gold, I think.
Now, when it comes to the different kinds of resource stocks to invest in, I know there's exploration, development, which are the more risky, higher reward, and then there's the mining stocks, the juniors, and then the majors, and also the royalty and streaming companies. What are you most bullish on right now?
Typically we have a lot in the exploration and juniors because, as you mentioned, that's where you get a lot of leverage. But I don't think you need to take the risk in that right now. For me, it's a matter of risk and reward. And if you look at the big cap stocks, I mentioned, Barrick, but you could look at Agnico, and then over in silver, Pan American or Wheaton River, the largest of them are extremely cheap. They're at 12-month or longer lows, and they're very, very cheap. So when the market turns, the big cap stocks are going to be the first to move, and more importantly, they're going to be the more certain to move. I mean, if you buy the four I just mentioned and gold's at 1900, I will bet you any amount of money you want that your portfolio of four stocks will be up. But if you buy Consolidated Moose Pasture and Ajax Exploration, they may or may not be up. I'm not going to take a bet on that. Now, they may be up more than the four I mentioned, but I don't know if they'll be up. So right now, we're focusing on the big cap miners for the reason that I just mentioned. We're also buying the larger royalties as well as the smaller royalties, the larger royalties, because royalty companies, remember, are not so exposed to inflation and higher costs as the mining companies. We've seen this very clearly in the results from all of the major companies in the last 6 weeks. Whereas everyone from Kinross to Yamana and Newmont were complaining about costs going up, Franco's costs actually declined. Franco-Nevada is the largest of the royalty companies. Their costs actually declined, and Wheaton's costs were only up because they had a production shortfall. Osisko's costs were basically flat. So, and Royal Gold's costs were basically flat. So the royalty companies can withstand higher costs a lot better than the miners. So for me, the big cap royalty companies, that's Franco-Nevada, Wheaton Precious, Royal Gold, and Osisko, they are the cornerstone of a portfolio. These are things, and I think they're all cheap right now. Everyone I just mentioned is cheap right now. So I would buy those and hold them for the duration and not keep looking at them every day. I'd also buy the senior companies on top of that. And then the time will come to buy the exploration companies.
All right. Well, Adrian, we really appreciate your time today. Thank you so much for your time and insights. Any last thoughts before we let you go, and where can our viewers find you online?
Well, you can find me online, before I forget, at www.adriandayassetmanagement.com. Yeah, the last thought I think I would say is to people who already invest. Well, first of all, gold bullion is incredibly cheap right now. So, I don't think you have to be too worried about that. For anyone invested in the gold stocks, I would just say don't give up. You always get people capitulating at the lows. When people who are in the sector for many years just start saying, you know what, I'm giving up. That's always when we're near to the low. And don't forget, as I mentioned, that when gold does turn, the gold and silver stocks are really set up, in my view, for very powerful rallies. So just hang in there.
It's definitely a good time to hang in there. I think we can't give financial advice, obviously, but it does seem like the sentiment is very low right now. And one thing that Rick Rule always says is that if you bought at a certain price and you believed the narrative at that price, if it falls lower, it's just a good idea to sit tight or buy some more, because if you still believe the narrative, then nothing's changed really. So it's definitely a good time, as you mentioned, to sit tight. But yeah, thank you so much, Adrian, for your time, and God bless.
Thank you very much for asking me, and God bless to you too. Thank you.
Miles Franklin Precious Metals.
is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.